Hey, there we are.
Good. Waiting for
Ready,
Caitlin.
ready to rock and roll. Yeah, I spent some time with Caitlin last week at the Bitcoin conference. You and I should have hooked up. You were there, right?
1 second.
Yeah.
All right, guys. We're just waiting for Caitlin now, but Andrew, good to see you,
Yeah.
man. How's it going?
Good, good to see you as well. Looks like we
Oh, hold
both
on one
enjoy our.
second. Oh, here we go. We have Caitlin.
Hey,
Let
howdy
me
guys.
change the
Hey,
music.
how are
Great.
How's everybody doing?
Awesome.
you?
Tired.
You're doing.
Good to see you in Nashville, Caitlin.
Yeah, it was great to see both of you.
Yeah.
I met both of you for the first time. Yeah.
Cool.
Yeah.
So
It
let's start this off by just reviewing this amazing announcement by Cantor at the show. I think it was one of the most underappreciated announcements, especially because you had the RFK announcement and the Trump announcement. But basically, in his 20-minute presentation, Howard Lutnick at the very end said, by the way, we have an announcement. We are going to be dedicating a $2 billion facility for lending against Bitcoin and then allowing leverage. And I think that's pretty significant. So I'd love to get your takes. Caitlin, first, what do you think?
Well, it was great. That was a really impassioned speech by Howard. I think that the bulk of the speech was not that. It was a defense of Tether and their activities with Tether and an impassioned defense from the attack by the anti-Tether Pro Circle folks. I was sitting with some OGs in the crowd who have been around a long time, and that's how we interpreted that. In terms of the lending announcement, yeah, obviously it's big news. It's not a shock because so many Wall Street firms, obviously, we've known they're coming. We've known for a couple of weeks now that thanks to somebody senior at the SEC, quote unquote, leaking to Bloomberg, that they're giving special exceptions from SAB 121 to several large banks, that the New Yorkers were coming. And it was interesting because I think the crowd I saw the crowd react two different ways. They were polite, thank God. When he defended the U.S. dollar system, obviously a lot of folks in that crowd are not defenders of the U.S. dollar system and are very suspicious of Wall Street. But they didn't hoot and holler when he said that. But I think they didn't understand who Cantor was. And I was actually talking with someone afterwards about the muted response. A lot of the 9/11 stuff, that crowd, folks, the three of us are, we've got the proverbial gray hair. We were all around on 9/11. I lost friends, not at Cantor, but at Fred Alger and Sandler O'Neill and KBW. But we remember it vividly. And a lot of folks in that room weren't even born. So, yeah. Anyway, what do you guys think?
Lutnick lost his entire firm on that.
Yeah, like 2/3 of the firm.
Literally his entire firm. So, his history there is remarkable and again, but not well known to probably 2/3 of the crowd in that room. Right.
Yeah.
I would say that the opportunity that he presented associated with a lending facility and all those things, I'm a believer, and I think Caitlin's a believer that folks that lend out their Bitcoin, it often gets departed very quickly. You just got to be very, very careful in those situations. Bitcoin is a volatile asset, even though it's been quote unquote less volatile over the last, let's call it 7 months. That doesn't mean that the very nature of Bitcoin has changed, and the ability for it to find itself into movements that would cause people to lose the grasp on their Bitcoin when it's in a lending sort of position. The other thing that I would add is that Caitlin has made some extraordinarily good points associated with systemic risk in the Bitcoin as an asset, and then Bitcoin ETFs, and how the whole machine works as it relates to the creation of shares for Bitcoin ETFs, and then the how shares are then the process of cash create. There's a big difference between a 24-hour, always on, 7 days a week market, and a market that's on from 9:30 to 4,
Right.
about 8/10 of the year, because there are a lot of holidays and all those things. So when you then introduce leverage, so to speak, into that already somewhat disjointed market, you're introducing risk. The other thing that I will add is that the fundamental nature of big banks and quote unquote investment banks in the United States, they continue over the last decade to have to reinvent themselves and how they make money. Okay. So Morgan Stanley has done a remarkable job of doing that.
Yeah.
They went from a quote unquote investment bank to a wealth management organization. Something like 60% of their profits come from working with, potentially folks like us and managing our money, right? Goldman Sachs has not been successful doing that. They've tried and tried and tried and tried and tried, and their bread and butter continues to be quote unquote an investment banking type of opportunities. So they rush to get into, being an authorized participant and doing so on every possible product. They're going to continue to rush to do that. I'm certain that the quote unquote, bigger banks that have been given a special exemption, one of them has to be Goldman Sachs. Why? They've got to continue to really, really hunt for ways to make more money. So I've said a lot there, but there's 3 or 4 different levels of potential risk associated with quote unquote leveraged Bitcoin.
Hey guys, can we pause and give our relative backgrounds? Because I think we all three come from Wall Street, but I don't even know your backgrounds. We only met through Twitter and finally shook hands very briefly at the conference. I wish we'd been able to spend time at the conference. I was just wall to wall. Far away.
Okay, so my background is I was an arb trader, bond trader on Wall Street for 6 years at the beginning of, I would say, the golden era of quantitative arb. So I joined in 86, and I was there from 86 to 93. Those were my years on Wall Street. And, I was with this group that kind of got known for the book Liar's Poker, right? So I was one of the math guys that was brought in. Literally they called us the Coneheads, right? To basically see if there was any opportunities in a whole number of different things, right? So I did a lot in Australia, in Japan, tons in Japan, and I did a lot also with things like Fannie Mae. I did $1 billion swap with Fannie Mae. They would just invented a new swap. So there's a lot of kind of capital market stuff that I did, and then I kept in touch with all my Wall Street buddies through the years, and so Wall Street as I knew it is very different from Wall Street today, right? Yeah. So when I was there, bonds were where things were at. Equities were sort of a second-class citizen,
Equities in Dallas.
Equities in Dallas, exactly.
I went through the Solomon Brothers training program, so
you did?
Okay, wow.
Yeah. Okay. Yeah. So which is sort of a legendary training program.
Yeah,
right?
absolutely.
Sure. Yeah. So look, I think I'm sort of a student of how kind of all this stuff's changed, and I look kind of to Andrew, to kind of see kind of where this ETF stuff is really kind of happening and the pulse of it. I kind of saw when this ETF was coming out that this thing that is Wall Street that keeps on changing, right? Mm-hmm. And the ETFs itself were just they were a minuscule thing in 2004, right? We went from 300 billion to 10 trillion in sort of total volume of ETFs, and I don't think people understand that the ETF sort of volume as a whole has gone up that much. So it's gone up 30x in the last 20 years. Yeah. So we have this. We have a new way. Wealth is managed differently. Active management is out. Passive management is in. Mutual funds are dead. Pretty much. Now we have ETFs for single stocks like Tesla. So I think we're in a new zone, new era, and I think Wall Street's very good at reinventing itself. And I think I am a fundamental believer that once it's finished fighting crypto, it will embrace crypto and it will find it is ingenious at finding ways to make money. To the point where, I mean, look, the financial sector of the U.S. economy is something like 13% of the, so Wall Street finds ways to employ, hundreds of thousands of people, 600,000 analysts, people who are financial advisors. There's 600,000 of them in the U.S. There's just an amazing number of people. So I am completely convinced that they're going to find ways to manage people's Bitcoin, to lend against people's Bitcoin. And I think one of the things that a lot of people who follow me are all the people who follow me are Bitcoiners, 100% of them. And 100% of them are asking, the one question that they all ask is, how can I live off my Bitcoin without selling my Bitcoin? That is the number one question, right? And I would say that, the one thing you can take out of Celsius is that there was perfect product market fit, right?
Yep.
That there, Celsius and BlockFi and Abra, all three of them, the idea of, hey, I want to earn a little extra yield on my Bitcoin, or I would like to borrow against my Bitcoin. Both of those things, clearly there's product market fit. Now, I don't think a lot of people are going to be trusting the next Celsius coming, the next startup,
That was definitely true in the audience, Fred, that there was when Howard made that announcement, there was a lot of, oh man, been there, done that. Is Wall Street going to manage this any better? Frankly, I thought Wall Street would be there last time. But what happened is the Sam Bankman-Frieds of the world left Wall Street and beat them at their own game by starting FTX. Now, that turned out to be a giant fraud, but he was massively over leveraged. And same thing with the other companies you mentioned, BlockFi and Celsius. But Andrew, I don't know your background. Tell us your background, then I'll tell you mine.
So my background, my first 10 years of my career, I was a financial advisor in wealth management. So just blocking and tackling and working with customers and clients, and frankly, gathering assets, because that's the nature of that business. So understanding how that business works on the ground level, is kind of foundational to where my thoughts come from. And then for a decade after that, I had a consulting firm that worked with executives at all of those firms. And then I started a media company that covered all of those firms in earnest. And that media company took off very, very, very fast and was very influential. And some of the firms loved what we did. Some of the firms hated what we did because we kind of gave a voice to advisors just at large. And so I ended up with a lot of phone numbers and relationships with the CEOs at all those wealth management companies. So my contacts are, let's call it 25 years old. And so, knowing the Cheryl Pennies and the Ron Krajewskis of the world, and who they are and what they do, and, sitting in their offices talking about where their companies are going and why and how, and also them sliding me information about this or that, and this could happen. And, I don't think Ron's going to see this stream, but I remember when they were about to buy Barclays Wealth Management here in the US, I was running my media company, and there were articles that came out. They're like, Barclays is an absolute dumpster fire. And he calls and he's like, just between you and I, don't you think Barclays it wouldn't be a dumpster fire if somebody bought it and, kind of cleaned it up? I'm like, Ron, that's an interesting point. What else would you like to add to these comments? And then like 2 days later, they announced that Stifel had bought Barclays here in the United States. So it's a, I guess it's a pretty distributed arc of involvement in traditional finance. Then once I sold that company in 2016, it's really when my journey with Bitcoin and crypto began. And then finding myself in a bunch of different rooms because I was very, very curious. Started a company that didn't work because, frankly, it competed with the likes of Masari, and we were about a year and a half behind Masari. And so they covered the data, research space in crypto really, really well. And then started the company that Tillman and I run now. So Just a long history in traditional finance and wealth management at several different levels. And so the relationships associated with, when I want to get a piece of information as it relates to like, okay, who's going to be next to say something good about Bitcoin ETFs at the corporate level, I just send a few texts and see what happens.
I was going to say you were absolutely the best follow when it came time to when all the ETF news was coming out.
Yeah,
it's so interesting.
It's a it is a the world of Bitcoin continues to evolve, and it continues to evolve at a breakneck pace. And from an inclusion standpoint, there's a large section of Bitcoiners that don't love the Wall Street inclusion, but it is the reality now. When you have, David Solomon, the CEO of Goldman Sachs, who has eschewed his DJ opportunities over the past year and a half because he was about to get fired for doing it, now talking about Bitcoin, and somebody like Larry Fink, who whenever he does a media hit now, that's one of the things that he absolutely leads with. You can't look away and say, well, Bitcoin is still this cypherpunk asset that is X, Y, and Z. It's now part of the lexicon of the world of finance. And so now how do you adjudicate your ownership and use of Bitcoin in a way that allows you to keep it as opposed to lose it? Because there's a long history of opportunities that turned into massive risks that took account balances to zero.
Especially counterparty credit risk. To your point,
1,000%, yes.
And there's really not much counterparty credit risk analysis going on in this space. What's so interesting is, Fred, you came from the trading side, Andrew, you came from wealth management, and I came from investment banking. So the three of us come from very different parts of Wall Street. I was a managing director at Morgan Stanley, left in 2016, was in capital markets, so I was on the origination side, and I did pensions. So I saw capital markets across the board, worked with a lot of traders, but I was on the investment banking side of the wall doing a lot of structuring and have a legal background. So all the legal regulatory piece it tends to be where I spend a lot of time. Before that was in equity research, worked for John Mack and Ozzie Grubel directly when they were co-CEOs of Credit Suisse in Zurich. And before that did bank M&A. And then also did some structuring in between, some large transformer reinsurance transactions to take risk off life insurance companies' balance sheets, and then also lending against life insurance cash values. So very interesting. I started actually, this is my fifth startup. Custodia is my fifth startup. There were 3 different businesses that I started on Wall Street, totally different careers than you guys did. But so that's our background. And I think that's important. I didn't even know all of that about you. I just knew you guys both had Wall Street backgrounds. Because when you get into the question of, is it good that Wall Street's here? You guys know I've been writing about that it's a double-edged sword for a long time. And that frankly, I still stand by my prediction I made back in 2016 for the first time, that Wall Street's going to get over its skis and not understand that Bitcoin's the apex predator of finance. And it's going to take somebody big down at some point, because they are going to get themselves over leveraged, not even necessarily knowingly. And how it's going to happen is the commingling of collateral, and they're going to end up more than one-to-one leverage. I'm a fan of leverage up to one-to-one. And Fred, this gets back to where you talked about the product market fit. A lot of people, a lot of hodlers have large unrealized capital gains and don't want to sell, but do want to monetize in dollars. And so there's definitely demand for that. But interesting question, is a wholesale firm, a big investment bank, going to be the place that's going to be able to push that out into retail when this is a retail product? It's fascinating because I don't know what the number is, but it's somewhere around 85% of Bitcoins are in retail hands. Only about 15% are in institutional hands. And those institutional ones turn over a lot. The 85% that are in diamond hand hodlers' hands like me don't turn over much, and some of those addresses have not had a transaction in my case many years, and so I think a lot of folks who want to apply the old paradigm to this asset class are going to get in trouble, because you cannot allow collateral substitution without keeping track of whether you're at least one-to-one collateralized in your Bitcoin portfolio, your Bitcoin exposures as a trading desk. And that's going to be difficult for the prime brokers because, as you guys know, the thing in prime brokerage right now is breaking down collateral silos and being able to allow collateral to be used across different trading, across different markets, and trying to bring those venues together in one place. But if the prime broker starts accepting, treasuries as collateral against a Bitcoin loan, very quickly they're going to get over their skis. And then that's no different than what happened to the Celsiuses and BlockFis of the world. There was a classic small B bank run, and there will only ever be 21 million Bitcoins.
Right.
So you guys tell me, will the prime brokers manage this better than Celsius and BlockFi? Go ahead.
They think that they can. We know that for certain, right? They're going to believe that they can, which may get them in trouble from the outset, right? Yeah. I look at Howard Lutnick's announcement, and what it feels like to me is he sees an opportunity to just grow the size and scale of his firm's chess piece on the chessboard, right?
Sure.
That becoming a somebody that matters in the space associated with the opportunity that is Bitcoin, a lending facility, and the size and scale of what that lending facility could grow to. You don't start with 2 billion and stay at 2 billion on Wall Street. Never happened, never will. So he made that announcement, but he wasn't making a claim that, hey, all of you retail Bitcoiners, come and sign up for an account at Cantor Fitzgerald. That's not at all what the nature of that conversation was. It was basically hanging out a sign, at the front of his store for Wall Street to begin to be involved with that type of lending facility. So again, the counterparty risk that you talk about is something that I frankly worry about. I don't think there's a world where we go from 65,000 Bitcoin back down to 35,000 Bitcoin with just the 8515 retail number that we're talking about. Can that happen with counterparty risk and a big blow up and a lending facility that goes absolutely upside down? You bet it can. That's where the risk is involved.
Well, I would like to. The only thing I'd like to change the discussion a little bit is I think that this thing is going to be a great wealth, like a wealth management and gathering of wealth assets, right? So, as a guy not who's been on Wall Street but who's sold a ton of companies, right? Mm-hmm. I've had 10 exits and started companies and sold them, all for $10 to $200 million, right? And I can tell you that when my first exit, Morgan Stanley called me up and they're like, Fred, great. Saw you sold this software company for 20 million and would love to have lunch. And would you like to open an account at Morgan Stanley? And would you like to potentially put a collar on your Macromedia shares? And then after the next company, it was Goldman Sachs who called me up and is like, Fred, we saw you sold another company. I know you have a relationship with Morgan Stanley, but we can do a slightly more interesting, collar swap. I can't even remember what it was the second time on these new vignette shares that you have, right? So, listen, I think that everybody and their brother is interested in this, wealth management fee business, right? And it used to be that you would go through the list of all these tech companies that were sold and you go to the, top 3 people in them and you'd try to get them to sign up to Merrill Lynch, Morgan Stanley, or Goldman Sachs, right? And I think what we are going to see in the next 2 to 3 years is you're going to see a ton of people who just happen to have a lot of Bitcoin,
Yeah.
And, those same guys are going to be like, Fred Krueger. Apparently, the guy's been doing Bitcoin conference channels, podcasting. The guy must have a lot of Bitcoin. Okay, let's talk to Fred Krueger and see what we can offer him. And the thing that's going to get me is not like their diversification and blah blah blah. The thing that'll get me is listen, we have this great lending platform for gentlemen such as yourself. And, what we really would like to show you is how you can live for the rest of your life on your Bitcoin without ever selling any of them. And we have this very, very safe way that you will never be called in the middle of the night. And by the way, the fact that we're not open in the middle of the night is an advantage for you because there won't be any capital call in the middle of the night, right? And we're going to segregate your exposure in a way where, your Bitcoin assets, you're going to have a week period. You're going to have some time. If we do need more collateral, you'll have some time. Maybe you're going to go sell some stocks to, bridge your Bitcoin collateral, right? But maybe you're going to have to take out a home equity loan if things really go bad, right? And you're going to sign the loan that you're going to sign is going to be a loan. You're going to be on the hook for this loan, right? But you're not going to have risk because it's going to be through Merrill Lynch. You're not going to have risk that Merrill Lynch is going to go bust the same way that Celsius went bust. Although Schwab, is looking a little iffy right here, but maybe the Schwab guys will say the same thing, right? But I just think that product is going to be it's going to resonate with a lot of people, right? And some guy, and by the way, I think in the same way that tech founders did generally for the most part in their first company don't have a relationship with Wall Street, right? But they do after selling their first company. They do have they do set up one of these guys gets them, right? And they become the client of Morgan Stanley or Merrill or whoever, right? So I think that's going to be the battleground for these wealth management firms. And, and it's sort of evergreen because they'll get the guys, they'll have Bitcoin. And then as the Bitcoin grows, over the years, these clients are going to be major clients of the firm, right? So it's a fantastic, if I were John Mack, I would be like, we're going to get all our guys to go canvas out all these Bitcoiners. We're going to show up and we're going to try to figure out who are the guys who own more than 500 Bitcoin. Okay. Let's find those guys.
It's so funny you're saying that.
Let's make sure every one of those sharks and whales. Okay. We know how many there are, right?
Yeah.
We can look at on-chain metrics, right? We know there's a couple thousand addresses that have 1,000 Bitcoin. There's 4,000 that have over 500. And let's make sure we have those guys on speed dial.
It's so funny because I was on Morgan Stanley's blockchain working group. I was one of the founding members of it. There were 5 of us. The CTO called me one day because he found me on a internal chat room. And this was 2014, 10 years ago. And it was a bunch of young folks and then a gray-haired managing director. And he called me and said, "You stick out like a sore thumb. Get up here and tell me what this is." And then pull me in. So it's so funny you're saying that, Fred, because I think that Ted Pick is probably doing that. A former colleague of mine back in capital markets who's now running Morgan Stanley. He's probably doing that. It'd be very smart to do that. But the skepticism 10 years ago was stunning, right? And it would have been smart if they had actually gotten ahead of it. But the regulators, I understand why they haven't. The regulators have obviously beaten everybody to a pulp. And what you're talking about in terms of the wealth managers wanting to really service Bitcoin, here's the problem. Right now, they can't because the Fed won't let them. Now, that said, I have it on very, 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 very good source that the the Fed just gave a very large bank the green light to custody Bitcoin. Obviously, from our lawsuit perspective, I'm very, very interested in learning that. It is true because that has not been the case before. And it started with the SEC 2 weeks ago granting the SAB 121 exemptions to the banks. I have always said that Bitcoin custody is going to go to banks as legal entities. That doesn't necessarily mean banks as in incumbent banks, because remember, 2 crypto native companies, Custodia Bank, my bank, and Kraken Bank are native, crypto native banks. And we are legally banks, so we qualify for the bankruptcy remote treatment. There's actually even better law in Wyoming that gives you a clear bailment to get clear segregation of the assets. So if we were ever to go bust, it wouldn't be part of the estate. Those custody customers' assets would truly belong to the custody customers. The SEC was not wrong to make that as a requirement. What they should have done from the beginning was say, here's how you qualify, as opposed to saying SAB 121 applies to literally everybody. And so a lot of the wealth management firms that you're talking about haven't been able to provide any products and services. They still cannot put Bitcoin on their balance sheet. We will eventually, the Basel III Bitcoin proposals get enacted in 2026. It's a 1,250% risk weighting, which at an 8% Tier 1 capital ratio is a dollar for dollar capital requirement to put Bitcoin on the balance sheet. So it's very expensive for banks to do that. But, and by the way, nobody runs an 8% Tier 1 levered or Tier 1 capital ratio. They run, 12 or 13, right? So it's more than dollar for dollar for a bank to put Bitcoin on its balance sheet in terms of capital requirement right now. But here's the point. The US hasn't adopted that yet. And because of this Warren crowd who's in charge of financial services regulation right now, they want to kill us all. But the funny thing is they're now letting the big banks have special exemptions. It's the most corporatist thing. I'm wondering, where are all the progressives? Why are they not screaming that their own people are giving the big banks special treatment? I digress. But they're coming. They're coming. But it's going to take a while for the U.S. still.
I have a question for both of you. Let's suppose we get past the, they can actually hold Bitcoin, right? Let's just suppose that. And let's suppose that, the productization of these loans kind of evolves to the point where they can kind of make the statement that it's not going to get liquidated immediately. What kind of interest rates, we're in a 5.5% interest rate environment right now on Fed funds, but what kind of interest rates do you see this thing coming down to, right? Because you can borrow right now on Unchained Capital and Ledden, and there's a bunch of kind of places you can borrow.
Yep.
But I mean, we're talking, 18%. Now it's better than the Capital One 30% credit card, rates that are being kind of, you see today, but you would think that once banks really figure this out, and once the regulations are in place, you would think that backed properly, and we're not talking about maybe 30% loan to value kind of numbers. You would think you could get in the 7%, 6-7% sort of rates. And that they could make money on that, So I don't know. I'm just throwing it out there. What kind of rates do you see as doable?
So, banks, these organizations they're going to default to how can we make the most money from the beginning. If we're going to offer a risk on product, then we better be able to make a pretty penny from it. And since they're going to see the Bitcoin crowd or the Bitcoin investor that comes to them as already a different category of risk on type of investor, well, they'll offer them something that they want, right? You keep bringing up this is what people want. Okay, how much money can we make with this without it getting outside of a particular lane that sounds egregious, right? So it'll start there. But as Caitlin, everybody on this call knows, everything on Wall Street is commoditized, right?
Yep.
So once the first person takes that risk and creates a number, then a bunch of products will happen within a matter of months that all the organizations will offer. And then that pricing, that interest rate, all the models associated with it will coalesce around a common theme and a common number. And it is what it is. It's now added to the 52 things that you sit around with your wealth management team and discuss twice a year in the conference room, on 6th Avenue at UBS. It'll just be part of the process. But where does it start? That's a really good question. There's been some things that have happened since the ETFs have been have come to the fore. Like I think it was the DDTC or something, that there was some adjustment or change that they made that you couldn't do certain things with the Bitcoin ETFs that you can with other ETFs. I'm trying to remember what that was, but it was basically a version of, hey, you can, with any other ETF, you can leverage this or do that or do this, but you can't with the Bitcoin ETFs for now, right?
Yeah.
And so
The fall's too high.
Exactly, right. So they're, again, it's going to take some time for this stuff to evolve, but I can tell you, when I would imagine that there was a good amount of folks that were at the Bitcoin conference this year and understood the significant shift associated with the type of people that own, sizable amounts of Bitcoin. Our own company, we have several clients there. One of the clients, his portfolio is very, very significant, and he's trying to figure out, okay, I've got 40 extra thousand acres of land that I want to monetize in a way, but I want to monetize it in a way that gets me more Bitcoin, right? So that kind of client already exists at a UBS or a Morgan Stanley. By the way, I hate Merrill Lynch. I'll never use them as an example. It's another conversation for another time. But what do they do with that guy? How do they service that guy's need with 40,000 acres of land in Texas that wants to do a deal with a Bitcoin mining company and make do a 20-year deal where he gets, 20 basis points of every Bitcoin that gets created, right? They're going to have to come up with ideas around that. That type of customer will grow in as a percentage, inside of their books of business. They'll have to deal with it, or else those customers will go find other ways to deal with it.
Right.
So, yeah, it is going to be a growing concern and something that they will be forced to evolve their philosophy and product mix with, because the customers are going to exist. They do exist.
But it's so interesting, Andrew, because Cantor is not a bank holding company regulated by the Fed. It's a primary dealer, but it's not Fed regulated to my knowledge. And the wealth management firms that you're talking about, all the ones you mentioned, are Fed regulated. So they can't offer those products to their customers because the Fed won't let them, because the Fed hates us and doesn't understand us and doesn't even, those of us who tried to work with them, look what they did. Yeah. They skewered us and are trying to kill us, right? So they're eventually going to have to figure this out. I can't wait till the Lummis bill comes out and they realize, because both the Fed and Treasury are impacted by the Lummis bill. But they're going to have to figure this out. They're going to have to engage with people who actually know what they're doing.
So, Caitlin, will you be offering Bitcoin-based lending at Custodia Bank?
No, we are not a lending bank. The Wyoming Special Purpose Depository Institution solved a particular problem, which is that we need bank charters that can bank the industry. But because the FDIC won't insure anything related to crypto, it had to be non-FDIC insured, which means it couldn't lend. So eventually, we can all get FDIC insurance eventually, the Wyoming Speedy banks. Custodia applied, we tried, but not under Marty Grunberg. We knew that we were not going to get it under, again, the Warren crowd's in charge. And they hate us, and they are blocking all of us. It was the Warren crowd at the Fed who blocked Custodia's master account. We will eventually get it. But yeah, until that Warren crowd is gone, we won't have insured depository institutions making Bitcoin-backed loans. It's going to have to be coming from other places. And again, now we pivot a little bit to the risk management on the banking side, because part of what happened to the banks that service this industry, where they were engaging in maturity transformation, typical borrow short-term and lend long-term banking type stuff, without understanding that the liabilities for this space could literally move at the speed of light. And we learned that. Obviously, we all learned when Silicon Valley Bank failed. Back then, the Fed's models were that bank runs happened over a 2-week period of time at the fastest, and that one happened over 48 hours. So obviously, this is all what's called in the banking world hot money, super hot money deposits. And so you cannot do any maturity transformation with them. So you're going to have to fund the loan book from longer term core deposits, not from this industry's deposits. So there's going to have to be segregation. It's just like in the prime brokerage business. If you don't segregate your Bitcoin exposures and make sure you have sufficient actual Bitcoin collateral to cover your exposures, you can easily get more than 1-to-1 leveraged. And then when the proverbial bank run happens, small b bank run, which happened to Celsius and BlockFi, the old Warren Buffett phrase, when the tide goes out, you see who's swimming naked, right? I would highly recommend that any of the prime brokers who are listening to this conversation be super careful. You need to segregate your Bitcoin collateral. You don't necessarily, you can commingle it as long as you're very carefully measuring it at every minute of every day. Because remember,
look, I also think as a person who might eventually use such a service, right?
Yep.
I would like to see, if I put in, let's just say I put in 100 Bitcoin, okay? I would like to see an address where that 100 Bitcoin is.
Yes. Proof of reserves. The Wyoming Speedy banks are required to have proof of reserves and proof of control of reserves. It is. I'm telling you, the Wyoming Speedy banks, we will eventually.
Right, but what I'm saying is, like, what I sort of see is the last thing I like. I mean, look, I had some Bitcoin on Celsius, a long time. I got out over a year.
So you're not one of the ones being sued for a clawback.
I'm not one of the. I know people who are, right?
Yeah.
I know people who are, and I know people who had to pay massive amounts, to kind of pre-settle this thing, right?
Yep.
So, but yeah, so Celsius had zero visibility as to what was happening now, and that nobody likes that, right? And what people really want,
they refused to do proof of reserves. They couldn't. Yeah.
Right. So I think what people really want is they want to say, here's my Bitcoin that I'm moving this Bitcoin to. Here it is. It's in an address. That address is no longer within my control, right? But I can see it. I can see it on chain, just like I can see the Bitwise reserves on chain, right? There's an address. But these are my Bitcoin that are there, right? They're sitting there, and I can verify every single day that nobody's touching them.
Yeah, but that's
so that's what I want.
requires.
And then basically, I want to be able to, and I'll be paying some interest, and it can be deducted from that account, or maybe that interest is separate. But I want to be able to see the Bitcoin not move, right?
Right.
That I think is the criteria, and so really the bank, whoever, Merrill Lynch on the other side, they need to basically have some way of custodying that Bitcoin in a segregated account, right? Segregated to Fred Krueger.
Oh my gosh. Okay. Fred, this is what the Wyoming Speedies do. Yes.
Well, that's what I think we want, right?
Right. And you actually see, here's the thing. Wyoming has such great foresight about clarity of property rights. The Wyoming law I alluded to earlier, that's even better than any other law elsewhere in the country, is that your legal title to the assets stays with you even when you turn over the property, the private keys, to a Wyoming custodian. So the way that securities custody works right now, and other types of custody, is the legal title. You hand your legal title to your securities over to your custodian, and they owe you a security entitlement back. It's called UCC Article 8. Wyoming, we can do that. We can at the Wyoming Speedy Banks, we can do UCC Article 8, but you get better protection if you choose this segregated bailment feature, which is unique under Wyoming law. No other state offers it.
All I'm just saying is, if that ends up being the way that this thing is rolled out, then bank runs are not so much of an issue, right?
Exactly. This is, you're making the case for why Wyoming Speedy Banks are ultimately where the custody business is going to go. This is where the custodians are going to be. The lenders don't have to be connected to the bank. So when you asked earlier about lending, we can facilitate that. We're authorized to facilitate that, but we're not authorized to make the loans ourselves. So we become a platform that provides custody services and is connected into the market makers.
So basically, you would be a custody. So it would be, the assets would be held there. I could look there, but then there would be somebody else that is providing the cash.
Correct.
And that there would be an agreement that, under certain loan to value things, something happens, right?
Yes,
and
you're closed out, or you get a margin call.
You're closed out. But I mean, I think that what is needed is sort of a not sort of this real time closeout, right? That real time closeout thing was the biggest risk, I think. And and certainly some people love it on Aave, and the DeFi world loves it. But I think that as a Bitcoiner, that's the last thing I want, right? The last thing I want is some, and what other risks are there? Well, there's smart contract risk, right?
Yeah.
There's the risk that some smart contract on Aave or Compound or whatever on Polygon or whatever, right? There's actual code risk, right? And
absolutely, yeah.
And so I feel like Wall Street, sort of CeFi can intervene to minimize that, right? There can be a sort of a buffer between the actual liquidation and the code, right? The code can say something's happened, alert, trigger, and now you go into a holding pattern where you're going to get notified and something happened, but the final liquidation is not going to happen by smart contract.
Yes,
and that's what I feel like that's the most important thing. We need to have a non-smart contract liquidation method.
That's so interesting. I don't know that exists right now, but here's the challenge, and this is
it doesn't exist right now. But I think that needs to be invented.
Yeah, it's an interesting idea. As long as you have other collateral that can be posted, this is what's so interesting about Cantor's affiliate BCG, because BCG is a single marketplace, as I understand it, where the collateral can be used in different venues. It's not siloed. And so there's one piece that I think BCG is missing, which is the US dollar piece. We'll come back in a minute and talk about that. But I suspect that this is where the announcement at the Bitcoin conference was going, that they want to be kind of a one-stop shop for traders, and the collateral can be used across different venues. And so to your point, Fred, because if your Bitcoin moves overnight and you wanted a period of time to be able in the morning to post additional collateral, as long as they had additional collateral in the family, then they may be willing to do that, with the one caveat, which is that they have to be very, very, very careful from a risk management perspective not to get over one-to-one leveraged. Because the moment they're over one-to-one leveraged, again, if they're accepting non-Bitcoin collateral for Bitcoin positions, they can easily lose track of how much exposure they have. And that's when one of these big financial institutions goes down at some point.
Look, I think that
Bitcoin's bigger.
That secondary piece of collateral, let's just say it's a house. Okay, just let's say it's a house. Let's say it's the stock portfolio, right? So the way I would typically view this is the guy from Merrill Lynch calls you, right? He's like, great, I noticed you have all this Bitcoin. This is what we recommend. We recommend taking half of it, put it in we'll manage that for you. We'll put it in a basket of ETFs and stocks and whatever. You'll have your Merrill Lynch guy assigned to you.
Yep.
And the other part of the Bitcoin, you can leverage on that. No problem. No problem at all. You can borrow against it, blah, blah, blah. You will not have any kind of immediate liquidation on it. It'll be a general loan. Now, Merrill Lynch is in particular, they're pretty aggressive on these kind of, jumbo loans and other things, right?
Bank products. They're Bank of Merrill. It's Bank of America. Merrill. Merrill just does small business.
Yeah. Well, remember, again, they're Fed regulated, right? Fed won't let them do anything with Bitcoin right now other than the ETFs. Yeah.
Right.
Oh, look, that has to change. But that probably, well, we don't know how this election is going to go, but I would have to say, if Trump gets elected, I would have to believe that's probably going to change in the next election cycle in the next 4 years. I would guess.
I talked to a very, 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 very senior Fed insider who was telling us about what happened to Custodia, and it wasn't the political appointees who were afraid of Bitcoin. It was the senior staff. That's not going to change. And what I'm told is that senior staff is talking to Warren's crowd every day. So I'm not sure that's going to change, Fred. It may take Congress to change. But we definitely want to swing back before we end this hour and talk about the U.S. dollar piece, because Andrew raised the U.S. dollar piece. I want to make sure before we go back to that, though, that we've covered all the Bitcoin margining and products that you would like to see Wall Street deliver.
You've made some really great points about how the blocker here is the Fed itself, right?
Absolutely, yes.
And the Fed and the staff under the Fed, and even if we get a different chairman, we've got the staff, and we have Elizabeth Warren, so
she's in control not just of several of the appointees, but also apparently some of the senior staff.
So I think there's a we're probably talking at the 10,000 feet level, right? We're a little bit in the weeds, but that's where most of the things happen. I think there's also a movement. Let's not forget that BlackRock, Citadel, and the like are working on starting an entirely new stock exchange that will work very, very differently than the current ones that we have. Probably even go away from T+1. They'll probably be blockchain, crypto type of, real world. All of that stuff will be integrated, right? So there may be regulatory or no regulatory, election or no election, there may be a collective force of will of a company like BlackRock, a company like Citadel, that over time forces change that, frankly, the regulators will have to adjust to in some way, shape, or form. It's hard to conceptualize that because the regulators are so powerful when you're dotting I's and crossing T's and trying to build architecture. But when an organization like that decides, we're going to start an entirely new stock exchange and nobody's going to stop us because we have the capital and ability to do that. And when the capital begins to form around something like that, and the rules that they've decided to use for that exchange, that's an entirely new paradigm. What comes out of that, I don't know. I don't know, but that's a real thing that is in motion right now. That over
in
time,
Texas, right?
We'll probably make real adjustments to the what we're talking about here. Right, what we're talking about, what are the shapes and levers and architecture that adjust and allow you to use your Bitcoin in different ways, lending, leverage, and the like. In my mind, we're talking probably about a force of will over the next 5 to 10 years, based on the fact that BlackRock and others want it to happen.
Okay, that's an amazing segue, because what you're talking about, you alluded in the beginning that it might not be T+1. It might go to T+0. Paxos was working on T+15 minutes. Okay, so there are places, there are venues where you can speed up settlement cycles, but here's the aha. You gotta have a bank that will settle the US dollars fast and can do smart contract based US dollar pieces. And the clearing banks just don't want to do it. In part because their processes are antiquated, their technology is antiquated, and they don't want to have to pay the people to extend hours. The Fed just put out for public comment a proposal to extend FedWire hours to 22 and a half hours. It's already something I don't know what it is, but it's a lot longer than the sort of 8:30 to 4 FedWire window that most banks have. FedWire is open a lot longer than that at the Fed. So why are the banks not open longer? They just don't want to be, because it's expensive for them to be. But to your point, those new trading venues are going to force that. And that's where the banks like ours, stay tuned, because we're Bitcoiners who started a bank. And we are thinking 24/7, 365.
Right.
And even though FedWires, we don't have a Fed account yet, but we are going to go longer, a lot longer hours. And we are going to service this community, because that takes out the risk. You and I talked, Andrew, about when I first started making this point about the Herstatt risk in the Bitcoin markets. Herstatt risk is a risk of a trade failing because a counterparty fails to deliver. Herstatt was a bank. It was a German financial institution that triggered cascading defaults. I think it was in the 1970s in the foreign exchange market. And what was discovered was something similar to what the SEC said about the Bitcoin lending spiral that had taken place in Bitcoin markets. Nobody knew how big the leverage was, and until it all came unwound. And that happened in the foreign exchange market. What was the solution? CLS Bank. What was the private version of CLS Bank that was serving the Bitcoin market? It was Sen and Signet. There's a tiny version today at Customers Bank called CBIT. Interesting lawsuit got filed yesterday with some interesting tidbits about CBIT that are now made public. But that's it. Sen and Signet, because the Warren crowd wanted to destroy the crypto market, they suicided those platforms and were not allowing those platforms to continue by having them be sold to other banks. Now, again, banks that engage in maturity transformation shouldn't be playing in those markets anyway. It should be banks that don't lend and have 100% cash to back customer deposits so that they can survive the run. But here's the point. The regulators shot themselves in the foot by suiciding Sen and Signet. So we're going to be bringing something like that back very soon at Custodia to service this market, because that is going to take risk out of the market. And right now, with the cash creates in the ETFs, the SEC, I talked about this at Bitcoin 2024, the SEC forced everybody in cash creates to go through US dollars, which means that all the Bitcoin trades that happen after hours and on weekends just pile up as unsettled, unsecured counterparty credit exposure. And now the clearing banks that handle the ETFs are involved, and that's where the exposure is. And those are GSIBs, global systemically important banks. Those are not tiny banks like Silvergate and Signature in the grand scheme of things.
That's right.
Okay, so this was a stupid decision, in my humble opinion, by the regulators to take away what was effectively a private CLS bank, and we're working on bringing it back. It's really important for the Bitcoin market to be able to not have to have those counterparty credit risks pile up during the day.
It was an emotional decision that they made based on their view of Bitcoin, or what they thought they needed, that they should have their view of Bitcoin based on, kind of who gives them their marching orders. It was really, really dumb. Doesn't make any sense. And I'll go back to an example of when you have that type of risk inside of a system that you just described. When it starts to go bad, you can't get in front of it fast enough.
Absolutely. It comes unwound fast.
And here's the example. First Republic Bank. First Republic Bank was a top 20 bank in the United States. Huge bank, huge money. Started to unravel. JP Morgan gives them $100 billion effectively over about 3 days. Didn't matter. Still came undone. The bank went belly up, and JP Morgan bought it for pennies on the dollar. It still failed, even though they were shoveling billions of dollars into that institution.
And that's new, right? That's a new thing. We didn't. This wasn't the case.
Well, because bank runs can happen so fast because of online banking, Fred. That's what we've learned. Yeah. And
guys,
the internet.
Listen, let's wrap it up. I just want to thank Caitlin for suggesting this thing, and Andrew, always great to have you, man. And last question: where do you guys see Bitcoin at the end of the year? Give me a number, Caitlin.
Bitcoin at the end of the year. I've said 80K many times. 80K for me.
80K. Okay. 80K.
I think it can go higher. I don't make predictions, but laser eyes till 100K. I'm not taking. I haven't taken the laser eyes off in years, guys, and I'm not taking it off until Lummis just said laser eyes until her bill is law. I might have those laser eyes on well past 100K.
Good. I love that. All right, guys. Thanks a lot.
Thank you. This was fun, guys. Really great to meet you in person in Nashville.